The cryptocurrency asset class is brimming with opportunity for investors. The explosion in stablecoins, crypto ETFs, options on crypto futures, and other vehicles are making crypto more easily accessible to investors and traders than ever. Meanwhile, a more permissive regulatory regime in Washington and other drivers are increasing adoption of blockchain technology by traditional financial firms. That said, the asset class also experiences things like the recent crypto wipeout. Described as a flash crash of sorts, it resulted in the liquidation of a reported $19 billion in crypto positions, with many cryptos losing huge slugs of value in the blink of an eye. So what happened? What's next? What do both novice and more experienced crypto investors need to know about where the industry is headed? I sat down with another all-new guest on the Money Show MoneyMasters Podcast to unpack it all. He's Nick Ducoff, Head of Institutional Growth at the Solana Foundation. Nick, welcome to the program. Well, Nick, thank you so much for joining me. Obviously, crypto is a very hot topic with our attendees at conferences and with everything going on in the markets lately. So I want to, though, start at the big picture, sort of 30,000 feet up. We have viewers and attendees who know the world inside out and those that are maybe just getting started. So why don't you talk a little bit about what the Solana Foundation does and how Solana fits into the crypto and blockchain architecture and the industry overall?
Sure. So first I'll start with what is Solana. Solana is the highest performant and most used public layer one blockchain in the world. And we're even beyond a blockchain. We're really a technology platform because pretty much any application can be built on top of the Solana blockchain, much like any application can be built on Amazon Web Services. The main difference being on a public blockchain, anybody can interoperate with any application built on top of it anywhere in the world, 24/7, permissionlessly. So it's really an incredible platform that has been built and has now over 80 million monthly users. That's about 1% of the world's population, and nearly $3 trillion have been transacted on the network just this year alone.
Nick, I want to talk a little bit about the difference between public blockchains and private ones, and what is the difference there? And again, the value proposition for Solana, how does that fit into things?
So I think the industry is taking a similar path as the cloud computing industry did. So if you look back before cloud computing, all hosting and server infrastructure was managed by companies themselves. So if you were hosting your own website, you were running a little box and you were publishing that to the web. Then there were co-located facilities, like Rackspace, which was based in San Antonio, where you could have little cordoned off areas that would help with semi-shared infrastructure where the facility was shared, but it was still your racks, right? That was maintained in part by the operator like a Rackspace. Then you had somebody like Amazon come out and say, hey, we're going to take care of all the hardware for you. All you have to do is push your code up to the cloud, and it's going to be deployed, and anyone can access it, anywhere in the world. And I think today with public and private blockchains, you're seeing something similar, where there are still some, regulated financial institutions that want to keep their data close and want to maintain their own infrastructure. However, I think the trend is very clearly moving to public blockchains because it's very expensive and cumbersome to run your own infrastructure. And not only is it expensive and cumbersome to run your own infrastructure, but then you're not able to access, the liquidity that's on the public blockchain. And Solana, as an example, is one of the kind of most used blockchains for stablecoins. Just this year, stablecoins have grown from under $5 billion on Solana to nearly $17 billion. That's, over 3.5 times growth in just 9 months. So clearly, I think that financial institutions want to access that liquidity, and thus they have to be connected to Solana mainnet.
I was going to get to that later anyway, but since you brought it up, let's talk about the stablecoin industry or that part of the business post the Genius Act. I mean, why is Solana, I guess, why ultimately could they lead the business? Could Solana lead the business in hosting of stablecoins?
Yeah, so Solana is doing really well with stablecoins for a number of reasons. It's very, very fast and very, very cheap. So currently, today, settlement on Solana is about 400 milliseconds. That's nearly instantaneous. And there's a new technology being developed, part of Solana, called Alpenglow, which is a new consensus mechanism that will further reduce that time to about 150 milliseconds. So number one, it's very, very fast. You and I can exchange money nearly instantaneously. The second thing is very, very cheap. So Solana has a median fee of about 1,000th of a cent, 0.001 cents. And that barely fluctuates. It really retains that cost even when there's spikes in the traffic, and that's thanks to something called local fee markets. So if there's a highly contested application where lots of people are trying to use it at the same time, they may have a priority fee that increases it modestly. Still, it would be in the cents, not dollars. Whereas if you and I were trying to do a transaction at the same time as that application was seeing that spike in traffic, we would still pay the base fee of that 1,000th percent. And this weekend was a really big example of why this is very important. So I don't know if you saw, but there was a flash crash in the blockchain space this weekend. And on Ethereum mainnet, it was hundreds of dollars per transaction. And even on layer twos like Base and Arbitrum, it was running as high as $50 per transaction. Meanwhile, Solana was in the cents. And I think it really proved out why it's so important to be built on the Solana blockchain, especially for stablecoins. Because if you're buying a coffee $3 at a coffee shop, you can't be paying $50, in fees for that transaction.
I'm definitely going to get back to what happened over the weekend in a minute, but I want to talk get to a few other questions first. And one of them was, earlier this year, I saw some comments you had advocating for banks to build on public blockchains and talking about why the FDIC, for example, should support that kind of innovation. Can you talk about how traditional banks, traditional financial institutions are making that move, or why they might want to make that move?
Sure. So I think they do want to make the move. They have been constrained by the regulator, and even still, I think that there's not enough clarity on some pretty key elements that the banks need clarity on. Banks really can't operate in a gray zone. You don't want banks to operate in a gray zone, right? For the security of our global financial infrastructure, you want banks to be operating clearly in the green zone. And one of the things that's a bit tricky is, for example, the Bank Secrecy Act requires that banks know who they're doing business with, at all times.
Yeah.
And so on a public blockchain, where you can have participants as validators in the network from all over the world who may not be known, to the person transacting, conceivably that person, could be a bad actor. And there are some solutions to that issue. Recently, a couple different companies in the Solana ecosystem announced different approaches to this, but the key thing is they will allow you to choose who validates your transactions if you're an application. So let's say I'm Citi or another global systematically important bank. I can say, hey, for my Citi applications, I only want this set of KYB validators, know your business, so they know who's validating those transactions. And so I think we're seeing, commercial solutions, to these problems, because of course the participants in the Solana network and all public networks want participation from the banks. And there is some tension there because, of course, Bitcoin was formed in part after the financial crisis, and has a decentralized finance that allows for peer-to-peer participation. But for us to go from today, there's about 300 billion of stablecoins. For us to go in the ecosystem from hundreds of billions to trillions, the blockchain ecosystem probably needs participation, from traditional financial institutions. And I think we're going to see it. You've got JP Morgan and others who have announced tokenized deposits. You've got Societe Generale, one of the largest banks in France, one of the 20 largest banks in the world, who has a stablecoin on Solana, a euro stablecoin. They announced a US dollar stablecoin. You have Fiserv, which is one of the largest technology providers to small and regional banks in the country, announced that they're building their stablecoin infrastructure on Solana. In fact, North Dakota Bank recently deployed a stablecoin via Fiserv on Solana. It's called Rough Rider. So, very exciting things happening with banks in the Solana ecosystem, and I think more regulatory clarity will help bring, more on in the coming years.
Yeah. Let's shift a little bit to, again, sort of partially the investment angle, and people that are watching this are going to be interested, either already invested in various vehicles, cryptocurrencies directly or through ETFs, or are wondering how that's going to unfold. What about the Solana versus sort of Ethereum institutional race? I know you had an interview with Milk Road Daily where you kind of talked about how that's shaking out. Why would you argue that Solana is going to be the one that's going to win this?
Yeah, so, analogies are often imperfect, but I'm going to use some analogies here, and these are often analogies used for various cryptocurrencies. So people will often refer to Bitcoin as digital gold. Ethereum and the Ethereum Foundation in particular often refers to Ethereum as digital oil. And I think Solana, we see ourselves as among, if not the fastest technology company growing in the world. And so if you look at what's really been a driver of investor returns over the last few years, it's been the Mag 7. Mag 7 now account for something like 30 or 40% of the entire S&P returns here in the United States. We think of Solana as part of the Mag 7. So think about it as Mag 8. And if you look at the growth rate of Solana relative to the growth rate of the rest of the Mag 7, Solana is growing about 4 times faster than the average of the Mag 7 companies. And so, if you want to own one of the, if not the fastest growing technology company in the world, probably makes sense to have some Solana.
Okay, fair enough. I know CME just rolled out options on Solana futures. As we're recording, we've got Solana ETFs that are probably on the cusp of SEC approval. Curious to see what you think that's going to mean for for the Solana overall and the industry. I mean, is this going to kind of move it up that step ladder in terms of acceptance and so on? And what does it mean for investors?
Oh, it's huge. I mean, if you look at Bitcoin adoption, for example, IBIT, which is BlackRock's iShares Bitcoin ETF, it's one of the most successful ETFs in the history of public markets. And I think it just shows that when you take a product, a digital asset, and make it easier for more traditional investors to buy, and that's both institutional investors, individuals for their retirement accounts, etc. People buy the things, and so we're very excited about the Solana ETF. Fidelity, VanEck, Bitwise, Franklin Templeton, a number of others have filings, many of which have recently been updated to include things like fees and infrastructure providers. That's usually among, if not the last step prior to SEC approval. Obviously, the government, we're recording this, on the 15th of October. The government is currently shut down, and so hard to get attention to some of these things by federal agencies like the SEC. But I think when the shutdown ends, you'll see these ETFs get approved, and it's really exciting. There is also another way that retail and institutional investors can access proxies for Solana,
Yeah.
which is through these DATs, the digital asset treasury companies. So, of course, MicroStrategy, run by Michael Saylor, is the most famous of these DATs for Bitcoin. There are now, as of yesterday, I saw 20 different Solana DATs out there, the largest being Forward Industries, which raised over $1.65 billion to buy Sol in the open market a couple weeks ago. And so that's another way that investors can access the product.
Got it. As we get towards the end of our conversation, I do want to pivot back to that crypto wipeout, whatever people want to call it, that happened this past weekend. I saw reports of numbers as high as $19 billion essentially in crypto positions liquidated. What happened there? What drove that? What does it say for maybe investors that are looking to get involved in the space? What kinds of questions does it raise, or things do they have to be aware of?
Yeah, so it was really interesting. So here's my understanding, and I think, this is still being unpacked. It was less than a week ago, but my understanding of what happened in part was there was a lot of sell activity. Prices were going down. And one exchange in particular, Binance, had a stablecoin, Athena USDE, which depegged from the dollar because there were more sellers than there were buyers. However, a stablecoin should have a price of $1. And the issue there again, this is my understanding based on the information that I've read about it, is that what would be more typical would be that the exchange would look at multiple price oracles across multiple trading venues to determine what the price of that asset should be, because it was trading not just on Binance, it was trading all over the place, Coinbase, on chain itself, everywhere. And virtually everywhere else, USDE was trading at par value, $1.
Yeah.
But Binance had less supply, and as a result, the price depegged from the dollar, and so that set off, a cascade of concerns across the industry. There was kind of a flash crash, so to speak, where a single wick, kind of like down virtually every cryptocurrency went down 20-30%. It came back almost instantaneously as folks realized kind of what was happening. Obviously, it didn't recover the full value to where it was previously, but I think now markets are down generally less than 10%. And so it largely recovered. But I think it's a great example of, one, you got a centralized exchange, which had its own kind of supply and demand for a particular native digital asset. However, on the blockchain itself, things were humming along, as they should. In fact, Solana didn't even hiccup, right? It saw its highest spike in activity. It registered over 100,000 actual TPS, during those moments, and stood up and performed exactly as the blockchain should have performed. And there were orderly liquidations in on-chain trading venues, but the off-chain trading venues, the centralized exchanges, had some issues. And I think it was just a absolutely perfect example for why more and more of this DeFi activity should happen on-chain and not off-chain.
Yeah. Well, I'm old enough to remember the day when I think Procter & Gamble briefly traded for a penny or something like that in the stock market. So sounds like a little bit of a similar type flash crash environment here. Nick, if you had to, just, as we wrap up, had to kind of look in your crystal ball at the next year, what do you think are maybe one or two of the most important developments you see coming down the pipe for the crypto space?
Yeah, so without question, the Genius Act was the most important thing that happened this year. Obviously, the current administration has been very permissive and has helped, move the industry forward. The Genius Act, though, was not an executive branch action. That was a legislative branch action, and I think that is really exciting. It was bicameral, and that's really exciting. I think the Clarity Act, which is currently in Congress being worked on, it will have a similar Cambrian explosion in activity. And what the Clarity Act does, among other things, is it will articulate the process in which these tokens will be either commodities or securities, and what types of what types of information statements or otherwise might be required, depending on whether the token is deemed a commodity or security, and how the industry, such as Coinbase and other participants in the industry as exchanges, need to do to participate and facilitate trading of these commodities and or securities if they are securities. And so I think that clarity, no pun intended, will be extraordinarily helpful. And just as the Genius Act has led to an explosion in stablecoins, I think the Clarity Act will lead to an explosion in more tokens.
Perfect. Well, I appreciate you taking some time out to chat here, Nick. Really insightful comments and great, I guess, vision for what this means for investors and what this means for the industry overall. So thank you. If you're watching this, viewers, your next chance to see experts like Nick talk about crypto as well as other parts of the financial markets is at the Money Show Masters Symposium in Sarasota, which is set for December 1st to 3rd at the Ritz-Carlton, Sarasota. Hope to see you there. And Nick, I hope to see you at a future Money Show event as well.
Thank you so much.